Morning, everybody. Welcome back to the Opportunistic Trader. It is just after 8:30 on December 4th. This is the second trading day of December. This is Mike Aronovitz, joined by Vince Lancy. Larry's actually out this morning, traveling right now.
Which means there will be profanity. I'm kidding.
There's going to be some excitement. Larry's been bringing some excitement recently, but getting everything started right now. Yesterday was a strong rally. We had the G20 over the weekend. Initially there was a fair amount of optimism in the equity markets, and risk assets rallied very nicely yesterday. None of them closed on their high though, and right now we come in this morning. S&P is down 8, Nasdaq is down 30, VIX is at 1670. Soybeans was something that we were talking about yesterday. We had Angie Setzer on. They rallied about 1.5% yesterday, came well off their highs. That's something that's very heavily tied to trade. So we'll talk more about that.
Hey, Mike, can I ask you an operational question here?
Sure.
You have control of the screen over there, as I am in wintry Stanford. If I send you a picture, can you load that for people to see?
Yeah, it'll take a few seconds. It depends how you send it, but yeah, we can get it up there.
Okay, I only say that because I have a picture, a graph, not a graph,
Yeah, send it over.
but a data sheet that's to Larry's point about I'd rather have the stock market end higher. I don't mean to interrupt.
Yeah,
But
no, actually send it over. I can get it up.
How should I do it? On the chat,
just
or should I
email
do it?
Well, you could put it in
Email
the
it?
chat. Everybody can see it in the chat, but also email it to me. That way, for video purposes, people can see it later.
Okay.
But right now, dollar's weaker. Not a huge amount. Yesterday, the pound traded below 127. Right now, got back above 128, but that's really Brexit centric. Euro's trading at 119. I'm sorry, 113.94. We traded below 112 on Friday. I'm sorry, below 113 on Friday. But dollar's a touch weaker. Aussie and CAD were stronger as they're more commodity tied, which is more tied to trade. Yesterday. Oil continues to move higher. We traded twice on Thursday and Friday below $50 in Jan Crude, and right now we're trading 53.75. So that continues to trade bid. There's talk of OPEC cuts, and we've also had a huge sell-off there. So that's an interesting market, and I'm seeing nat gas up 3.25%. So a strong energy day as of right now. But one of the big topics that the market is talking about is the yield curve at the moment. One interesting point from yesterday was that on such an optimistic, if the trade deal over the weekend was so optimistic, why are yields, which is in a way higher yields are a sign of strength in an economy and in the world, and yields were actually lower yesterday. They reversed, and so that was something interesting. But more specifically in the yield curve, the market's starting to invert. 2s and 5s have inverted. The 2-year right now, as we speak, is sorry, I just took off that page, but it's the 2-year is 283.5, and the 5-year is 282, and the 10-year is 296 right now. So the 10-year got above 325, close to 330 a few weeks ago, and we've come a far away from there. We're 296 right now. But also, if you take a look at where the 2s are versus the 10s, that's 13 basis points, 1-3, which is the flattest it's been in a long time, since before 2008. And there's a lot of implications that people typically look at. Typically, that is a recessionary sort of indicator. That said, a lot of people are pointing to reasons why this is different this time. And so it's just really something to pay attention to. I know that we're going to speak a lot about it with the different speakers today. But Vince, what are your thoughts on the yield curve and what it's doing over the past few days?
By proxy, I have a lot of experience with the yield curve because it's term structure, and if you trade volatility, especially over time, and Tom trades a lot of this, you have to understand term structures of volatility. And I've actually written articles on it on the silver curve, which is a yield curve. All right. First of all, before we get to the meat of this, I want to explain to anyone stocks, bonds, commodities. All right. But let's stay with stocks and bonds. A yield curve, or a term structure, from spot, meaning the front month or before the front month, to infinity, should be contango. And that should reflect the cost of money going up over time. Now, at infinity, the cost of money should be, let's say, 6%. I'll just make a number up. At infinity plus 1 year, it's still 6%. So in the future, you want to start this way. When you're analyzing a yield curve for the first time, start with these basics. At infinity, the yield curve is flat, and that's marginal utility. So at infinity, our yield curve should be flat. All right. If we so, and then it should be sloping downward, not based on the cost of money. Now, that happens in markets like stocks that reflect the cost of money. If 30-day interest rates are 1% and 60-day 2%, you'll see a steepening of the curve. You'll see that in gold, you'll see that in stock futures, and you'll see that in bonds. But you won't see that in bonds because bonds are the yield curve that determine other yield curves, and this is what we're getting at here. There's a couple basics to take away from this before we get into the advanced stuff, and the basics are: a flat yield curve is recessionary. A fully inverted yield curve is a yield curve that is fighting inflation. Inverted meaning backwardated. A contango yield curve is normal. The steeper a yield curve goes in contango, the higher inflation is perceived to be down the road. The flatter yield curve is, the less inflation is perceived to be down the road as opposed to now. The reason a flat yield curve is recessionary, other than the fact that people keep telling you that, is because if a yield curve is flat, then I, as an investor, have no interest. I have no incentive to go out further and invest in a project, capital expenditure 10 years at 4%, than I would do at 3 months at 4%. And so a flat yield curve disincentivizes proper investment in long-term capital expenditures. So that's the textbook stuff. And I could go on and on about that, but I won't. And Mike would stop me anyway, and he'd be right to do that. The inversions of the yield curve, before I put on the tinfoil conspiracy theory hat, which is not a conspiracy theory. Most people look at the 2s versus 10s flattener. Now, we're not flattening at the 2s versus 10s first. We're flattening at, what'd you say, Mike? Is it the 3s and 5s?
2s and 5s.
Okay, so without getting paranoid yet, all right? Because I'll throw the touch of paranoia in there for everyone in a minute. This is a yield curve in transition. So to say that the yield curve is inverted, and I don't think Mike said that, is wrong. To say that the yield curve is inverted in one area is right. These things don't happen in knee-jerk reaction. It's a slow process. So if this were to continue, you would expect, in almost like a 1980s pixelated type of thing, the yield curve to invert down the road. Boom, 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 boom. The 2s go over the 5s. The 5s go over the 6s. It doesn't happen all at once. It's not continuously liquid. It doesn't happen in a smooth world. The world does not happen in a straight line. It happens in fits and starts. Now, if this were to continue, the 2s and 5s, the 2s go over the 5s, the 2s go over the 6s, then what you have is a curve that, as an arbitrager, should be crushed. And this is what I used to do with volatility, and I did it in silver futures. If the 2-year, I want you to look at this, look at the yield curve if you can. If the 2-year yield is higher than, let's make it really simple. If the 2-year yield is 10% and the 5-year yield is 2%, and the 10-year and the 2.5, so we'll make it equidistant: 2s, 5s, and 8s. If the 2-year yield is 10%, the 5-year yield is 2%, and the 8-year yield is 10%, what you do is you buy the 2-year yield and collect 10%. You sell 2 of the 5-year yields and you pay 2% twice. And then you buy the 8-year yield, putting on a calendar term structure butterfly, and you lock in a lot of money. Because as all these things converge, they all converge to spot. You might have margin calls that may go against you further, but this is the essence of term structure arbitrage, yield curve arbitrage. Read about it in a little bit about a taste of it in the book, what do you call it, Liar's Poker. But here's the thing: whenever, as a person who has grown up arbitraging yield curves and arbitraging term structures of volatility and living off of arbitrage. I look at that. The first time I looked at that, Mike, I said, well, why isn't anybody whacking this back where it should be? And I actually put a bond trade on one time for that reason, and it just didn't get. It just stayed that way for months, and then I got an education, and the education was this: the reason it's not whacked back into place is because there's other money being made at easier levels by these dealers. So it stays that way until it inverts. There's lower lying fruit that's more liquid. Now, to the fundamentals of this, what this implies, which is I think what people really want to focus on. You can look at this two ways. If you see the twos going over the fives, okay, you can make the point, oh, we're going to recession. The whole curve is going to flatten at the 10-year. It's not necessarily inflationary at the twos over fives. It's only if the twos go over the 10s or the twos go over the 30s. So this is a recessionary comment. The yield curve is flattening. The twos are over the fives, but we're flattening. When the twos get with the 10s, then the Fed has to stop QT. This is a clarion call to stop QT. The bond market traditionally does discount economic activity a year to 2 years out, where stocks discount at 6 months out. It's more like 6 minutes, but you get my point. If you look at it from the flip side, you could say, well, the twos are over the fives. I don't think it'll last long. I'm going to smack the twos and buy the fives. And that may happen, and has happened before. But I think people are going to continue to harp on this as a yield curve flattener. And Mike, agree with me or disagree with me, or please add color to this, because I'm talking a lot, and I want to make sure that I'm not going down a rabbit hole. If the twos remain above the fives, say for another day or two, and stocks go lower, then the stock market, I believe, is taking it as a cue of recession on the offing, and at the same time, not thinking QT will back off or Powell will back off. I'm not saying it has to be right,
Well,
but is that my logic valid?
not not there could be a number of reasons why the market goes up or down, not necessarily directly because of the yield curve or
No,
what
no.
is happening with the
I'm.
yields.
But when I speak like that, I'm not referring to different factors. I isolate every other factor except those two things. Obviously there are other
Sure.
reasons.
I mean, there's one historic way of looking at it is when yields start to invert, it's not a great sign.
Right. There you go. Okay. Right. When yields start to invert, it's not a great sign. That's true. Uh, 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 it, the Fed will, if during the Volcker years the yield curve inverted intentionally because they wanted to uh, slow down the economy in the short term, and by slowing down the economy in the short term, putting yields at say 15%, you actually can make the long-term yield go down because it's a perception that you're squashing long-term yields. I personally think, and for what it's worth, um, uh, we're going to have an end to QT at some point. That's a vague statement, but let's say it happens when the S&P trades 2,000, which I think is going to happen. If all those things happen, then you'll start to see the yield curve. I don't know if it'll steepen or if it'll flatten, but the 30-year will start trading higher. And people should look for terms like this: bearish flattening versus bullish flattening. And a bearish flattening would be the front's going up, meaning it's bearish for the stock market. A bullish flattening would be the back's coming down. So that's a perception of lower inflation. I hope that makes sense.
Yeah, that's a lot of good information there. First off, I want to let you know I do have that chart up if you wanted to talk about that. I don't have it up actually. Just let me know when you want me to put that up because it does have some interesting stats on there.
Yeah, yeah. You can put it up when we start talking about stocks, because I think this plays into Larry very rarely talks macro, or doesn't, or he doesn't really. He rarely talks macro with a bias. But if you look, working with Larry and trying to get an opinion out of him is like working with my first boss in options. And basically, there's two ways to learn. You can read a book and follow a manual and be taught in a textbook fashion, which I can do, and which we all can. I can demonstrate and teach that way. Uh, But you have to be able to learn when you're with traders by just attaching yourself to their belt and listening to everything and starting to formulate what they mean. So Larry may not talk a lot about macro except to, make light of the reasons for macro moves, and he trades in the micro. But something he's been saying a lot recently that I think we should pay attention to, and I looked for reasons for him to be wrong, and I found the reason he was right. That's how I work. He has been saying for the last several weeks, I would like to see a positive year in the stock market, presumably for better downside trading next year. And I found a stat, a chart, not a chart, but a data pulled up by someone on Twitter. It might have been Steve Bolello. I don't want to be unappreciative. If you could put it up now, that would be good, so people can look at that. Um, but basically, if you look at the last, I don't know, 12 years or so, uh, and this is a snapshot, right? We're not looking at a big data piece here, but we're looking at a data piece I think that's relevant because it's right before the crisis in 2007, and it goes through the whole QE period. Now, the market, the VIX, and I say this about the VIX all the time. When you look at the monthly VIX, it's a bear market with long wicks above. If you look at a monthly chart, but if you look at this here, in every month, right? I mean, just look at it. It's obvious. In every month there's only two of them, right? But in months where the VIX is up, you'll notice that the S&P is also up a little bit. And then the month after that, there's only two pieces here. So 2007, the VIX was up 38%, which is really not a lot when you think about it. 38%. It's the vol of vol, but I don't want to get into that. But the S&P was only up 3.5%. So here we are, 2018, and the VIX is up 30%, and the S&P is up 2%. So the obvious thing is the only thing that really extrapolates, the only thing that really trends in the world is human vision. And by that, I mean is it's easy to conclude that 2019 gives an indication that the VIX could be a lot higher and stocks could be a lot lower. And I agree with that, but not for the obvious reasons that we can see with our eyes here. I agree with that because I understand how the VIX works. And the VIX works like this. It's a sale until it's not. You should sell the VIX and pick up nickels in front of steamrollers as long as you're doing it in a diversified manner over a long period of time. But when it goes up, it blows people out. So if you look at a monthly chart of the VIX, you'll see it's candles with long wicks above, never long wicks below. And that's because the VIX is a product created to be shorted. But look at this here. You have a VIX in 2017 that was down 72%, and now it's up 30%. That's not a big move, but the S&P is in single digits. So 2019 could be the year where you want to swing trade from the downside on the S&P. And I think as much as I was searching to find something to make Larry wrong, I found something, and that's because I want to keep myself honest as a trader. I found something that corroborates this. So keep this in mind, guys. An up year in single digits with the VIX up means there's probably more trouble ahead, and that's all I can say to it. I mean, what do you see there, Mike?
Yeah, I mean, it's definitely something to keep an eye on. VIX right now. It also, I just want to take the other side as well. I mean, VIX started the year. I don't have the exact level that it started the year, but it might have started the year below 10 at such a depressed level that's also part of the reason why it's moving.
Right.
It's skewed that way. But
good
it
point.
definitely spells the point for years to come that there's going to be some volatility ahead, and I don't think that anybody's disputing that. We have this 90-day tariff sort of timetable for talks, and everybody expects that that's going to end at some point with a lot of, at least before it ends over that 90-day period, that there will be a lot of heated talk back and forth. There's definitely going to be a lot of volatility. Look, we're at a point where the Fed has begun tightening. We don't know what the ramifications are for that. Other central banks are taking liquidity out of the market, and I think that's part of the volatility that we've been seeing. This year has been a difficult year. S&P has bounced back now over the past 6 or 7 days, where it's back up on the year. Nasdaq's up nicely on the year, but global equity markets are still down and having a very bad year, worst year since 2008. And a lot of other strategies, whether you look at commodity traders, if you take a look at crypto, if you take a look at high yield growth, even some real estate strategies are not doing well this year. And so it's been 2018 has not been a good year for investing. And, it coincides with the Fed raising rates for the first time in 10 years. So there's definitely going to be opportunity and volatility. And the VIX itself, it's almost debatable how, it's a broken product. That said, it gives a viable indication of where volatility is. But
That's funny that you say that. That it's a broken product.
It has flaws. It has flaws.
No, hold on. I'm agreeing with you. It is a broken product. I did a paper on the oil VIX, and the VIX is a broken product because it doesn't reflect wings properly, and it's arbitraged all the time. The VIX is a broken product, number one. Number two, the skew product that they created to replace the VIX isn't a proper product. It is a broken product. It's not a leading indicator. It's a lagging indicator, especially when people don't use it the way it was intended to be used, and they only hedge with one-day straddles. You want to make volatility go up and scare the crap out of people. Cancel one-day straddles, and then the VIX won't be broken anymore, because that's what's going on. The VIX product is not a good indicator of anything except volatility. Doesn't predict anything. So yeah, you're right.
Well, you make a very good point as well. The fact that we've changed, the world has changed from 10 years ago, 20 years ago, to having monthly expirations or quarterly expirations to having Monday, Wednesday, Friday expirations. And so the way that people hedge is completely different. And that leads to some flaws at times, where you get these large spikes in both directions because there's almost a catch-up. When there's a large move, it's like, okay, now you have to buy this sort of wings or exposure, which can alter the actual underlying price itself in the short term.
Right. That's tied in with I want to go back to Japan. When Japan adopted the just-in-time concept of supply chain management, it actually happens in the markets now. And by that, I mean, I'm not going to buy a 90-day insurance policy. I'm going to buy a one-day insurance policy. And you see this in commercial paper. This is how markets blow up now. They don't blow up all at once. They blow up like this. If you know the bond markets, they blow up like this. I'm not going to finance 5 years out. I'm going to continually roll my 30-day financing. And that's the kind of thing you're seeing with the VIX. So I'll buy the spot option. And when it expires, I'll buy the next spot option. And what ends up happening is the roll, right? Picture oil traders should see this. I'm bullish oil. I'm just going to buy, or actually I'm bearish oil. I'm going to sell the spot month. And they keep selling it, and they keep collecting that contango, and they keep making that money on the roll. And then one day there's a real shortage, and the front inverts, and they end up getting hosed on the roll. The point is, and you're seeing it in the yield curve right now, which brings us back to yield curve. The short-term mentality of people and companies that can't afford to tie up too much cash in long-term insurance or hedging is going to be their undoing in a different way. It'll be a slow thing that becomes a big thing in the back end. Are there any currencies or stocks that you're looking at, or indices today, or anything that Larry left you with?
Well, the few things I did want to mention. Sorry, moving away from the mic. We posted in the November New York ISM came out, and it was weaker. It's actually 7-month lows. Employment was weaker. Really, all sides of it was weaker. And so, that's just another. It's not the most important ISM figure, but it's a telling indicator. But regarding specific levels, Larry will be in the chat later. He continues to be bearish. He missed yesterday's signal, and he wanted me to talk about a little bit about the way that we had such an aggressive gap. Typically, it's difficult to find exactly when to sell it, and because sometimes it stays there and then grinds a bit higher, like we actually saw overnight. And he's still looking for the right opportunity to sell. And it's overnight in U.S. time. We actually did trade S&P down to 27.67 and a quarter, which almost fully filled Friday's gap, which Tracy was talking about yesterday. She was saying if we can get down into the mid 60s, that's a level to possibly buy off of. Larry is still bearish and he's looking to fade. I don't have the specific levels, but I definitely think if we got back towards yesterday's, in the 27.90 level, that's kind of where he'd be looking to fade. He's doesn't buy kind of the weekend rhetoric that things are going well and that the trade talks are going well. He thinks that there will be more turbulence ahead. He's looking at the yield curve. He's looking at a number of different indicators. And he thinks that before year end that there will be another trip lower in S&P back back to the 2,700 level, possibly testing flat on the year.
I hope he's wrong, and I hope he's wrong because I want him to be right for next year. Meaning, I hope the market closes strong. I'm not saying I don't want it to be lower today or tomorrow for scalping purposes, but I certainly hope he's listening, and I hope he's wrong for the end of the year because next year will be even that better.
Well, he's been saying that as well, that he kind of prefers an up year because it shows, once again, the underperformance of, S&P would then be up a few percent, and a lot of people are underperforming. A lot of people are down, 0 to 7%, and, the S&P is now up a few percent on the year. But there's going to be a lot of different opportunities. We still have the Fed coming up this mid-month. A lot of trade talk. There's still a lot of different things out there before we call it end of the year. It is already December 4th, so it's amazing. That probably is, and then we have a day off tomorrow. We will be here. The Opportunistic Trader will be here. We do recognize that it'll be quiet. So, if you have any questions, things like that, you can ask them. We will have some webinars. I wanted to get to today. We actually have an interesting day. We've got Tom McEntee and Vince Lance will be coming back at 11 talking options. One thing teasing, yesterday Vince posted something about a $97 million trading strategy. Take a look at that post before the 11 o'clock if you have a chance, because he'll be touching on that, and Tom will be getting into some different option strategies. Really good segment where they really teach some different basic option strategies to some more complex thoughts, and so they take you through the option world. So that'll be 11 o'clock. Then 12 o'clock we have Adam Collins going over the latest COT data and market seasonality. So we'll see market seasonality-wise what's in store for December typically. And then 1 o'clock, interesting webinar. We have Larry Schnurmacher of Fido Partners. Fido is a private equity firm investing specifically in the cannabis space. He joined us a few months ago, and he was talking about the cannabis sector, and there's a lot going on in cannabis, so he's really connected there. So it's always an interesting conversation there. He has specific investment ideas that his firm is investing in.
Can I ask questions when he's on?
Of course, of course.
Can I ask him if he's short Frito-Lay as a hedge?
You can ask him whatever you want.
Okay.
He's a good guy. He's been on with us once before. A lot of good info there.
Hey, about the options thing, thanks, Mike, for that. I want to address the people who are interested and tune into the options thing with Tom and myself. It's a work in progress, but we think we have something we're going to be implementing soon. Not tomorrow, but soon. It's obvious to us, and what we've been trying to do, because Tom and I can speak at the high end and low end, but by that I mean beginner and esoteric levels about options. It's tough to mix that into a class, and so Mike has been giving us almost an hour to do that, and we don't want people who understand what a call spread is to lose interest. So you'll see us go back and forth, and that's that immersion thing, attaching yourself to a belt. But at the same time, what Tom and I are going to be doing, although it's not, I don't have it fully lined up yet, but this is what I've done. I've given classes at UConn on capital markets in finance, because UConn is near me, and I've done a paper on some really, high end. But because of the relationship I have there, and possibly becoming an adjunct professor, they're offering me a classroom after 5 p.m., in which I'll also have UConn students going to discuss beginning options. This is a call, this is a put, and believe me, it's fun. I can make it fun. It's not going to be a snooze fest. So I'll have a whiteboard. And so the plan is, so Tom and I can talk more high end stuff and really confuse the crap out of you on esoteric stuff. The plan is, hopefully inputted in a week or two, is that I'm going to be giving a class at UConn, and I'm going to have a camera at the back. Now, I'll coordinate this with Mike if we're going to broadcast it live or if we're going to record it and put it up the next day. But it'll be at 5 o'clock. And that class will be beginning textbook class. This is a call spread. This is that, and take you through and bring you up so that when you're looking at those TD Ameritrade charts and they're giving you all these recommendations, you can look at it with a critical eye and understand. And at the same time, subscribers and people who understand options and want to learn more at a more esoteric level will be able to focus more on what Tom and I do on the fly. So we really encourage everyone to ask questions, whether it be from the basics to the advanced, because if you listen to us carefully, you will know that Tom goes down a rabbit hole and I bring him back. I go down a rabbit hole and Tom brings me back. We try and keep it so that there's something for everyone. There are things I love to discuss, like EOO arbitrage or things like Weezu or Triple M, terms that I learned as a kid, or how I used to put thumbtacks in my elbows on the floor. But we've got to talk about the basics as well. Sunil, thank you very much. The class is on basics, but it'll be fun. I'll actually teach some games on how to play options with your friends and how to take money from them, kind of like dreidel or gambling. John, thanks. We'll be on at 11 a.m. I want questions from you guys, whether it be what is leptokurtosis to how can I express a call spread with low risk. With regards to the other stuff that Mike alluded to, I think it's really important to take advantage of these things and ask questions to educate yourself. 50% of what you learn in trading is through experience, and the other 50% is from asking questions. So that's my contribution, and there will be abuse between Tom and myself today, as he is Irish and I'm Italian. We have some jokes going back and forth. Mike, thank you so much for that. And
yeah, no, it's we started this segment last week, and we've gotten great reviews about it. A lot of great education. A lot of people come to our site and they're getting Larry's trades, which have done very well, and they're getting a lot of information. But some people have been asking for more on the education side in addition. And last week we got some good reviews because that was a lot of great education on the markets, and so it's good to see, and we appreciate that.
Yeah.
So that's what we're gonna.
I want to say something in general about the site and about the people on it, and about the philosophy behind it. And I'm speaking for myself and why I work with Larry and Mike here. And I think I think this is relevant because we get a lot more people listening to this than the gold fix. Because you people are stupid. Gold is important. I'm just kidding. When someone has been as successful as Larry has been trading, it's very dangerous when you're a subject or a chapter in a book on Market Wizards to start a retail website. It's almost a step down. It could cheapen your brand. And Larry is doing this on great risk. Now, I'm not a fanboy of Larry. We debate concepts all the time, more off the air than on the air, but I respect him because a man who can retire and not work the rest of his life, who wants to do this, people will ask, well, why? If he's so successful, why do something like this? I'll tell you why. The reason is he has children. That's how I look at it. And you can't pass on trading skills in the form of a business or a legacy to your kids. Now, I'm not speaking for him. I'm speaking about my opinion because I did this as well. I had an 8-figure year and I retired and I started a new business. And that business was a website geared to educating people. And why did I do that? Because a private company based on trading or sales is worth 1 to 2 times revenues. A publicly traded company is worth 10 to 20 times earnings. So, what Larry is doing here, in my opinion, from my observation, is he's not afraid to take his trading skills. He can make money anytime. He wants to make something that helps a lot of people. So, I think it's important to understand that, there are a lot of people out there that just collect money and drink Red Bull. This is the real deal. And this is this is the $20 bill you find on the street. This is the inefficient market. You're in a really good place here. And I'm thankful. We should be all thankful to have a person that's willing to step out and take a risk, if not just for himself, and possibly making 10 to 20 times earnings if he goes public, if not just because he can have a legacy to leave his children. Who cares? But he's the real deal. This is not BS. And there's a lot of people out there that talk BS. Larry doesn't. And you know how you know he doesn't talk BS? Because I can't tell why he does trades. And I say that with a smile on my face, because traders don't want to tell you, and you have to pull it out of them. You have to learn and you have to pay attention. You know, this is really an important site. And the content here, we don't have to have this site. I've told Larry, and he said no. I said this to Larry, and he said no. I said, Larry, shut the site down and sell the content to idiots on other sites. And he said no. And I said, why? This is so much hard work. Why can't you just take the content you have and sell it to someone else? Don't cheapen your name. He's like, I'm willing to take that risk because I want to build something here. So pay attention to that. This is real. Sometimes there are opportunities in the market, and this is an arbitrage. This is a guy who's coming down and giving you insight. It's the real deal, folks. I'm the real deal, warts and all, and thank you, Bryn, for saying that. Bryn Kelly is the real deal. Tracy is the real deal. It's nonsense. This is the real deal. And trust me when I say this. This site offers more than anyone out there. We just don't have it in stupid, shiny wrapping paper that everyone else does. Tell your friends. Tell all your hedge fund manager friends that are in danger of losing their jobs because they don't have any good ideas. Sign up to this site because they'll keep their jobs. Anyway, that's how I feel about it.
Well, there's Vince's take, and appreciate the words.
And go to fmxconnect.com. No, I'm not pushing it. The site's inactive. Go to fmxconnect.com, and you'll see what I built 10 years ago after I retired for my kids. And it failed because I realized I was getting hosed by some people that were involved in it. And I walked away from it to start trading again.
All right.
Well, won't walk away.
Well, back to the markets here. S&P down 7, Nasdaq's down 25, VIX is 1663. It'll be interesting to keep an eye on VIX because we were trading about 1950 before the G20. We were expecting, Larry was saying all along that VIX would get crushed after, as we have seen. But right now, the DEES future is actually trading 17, whereas spot VIX is trading 1664. But also on the radar, crude traded 54.55 overnight, and we're now trading barely higher on the day. We're up 30 cents at 53.26. The telltale for the past past 6 weeks when crude has gone lower has been daytime selling of crude. So, we'll keep an eye on that to see how crude trades during the day session. But we're gonna have Joe
actually
back.
Bryn and Sunil are on. I'm gonna ask them for a couple ideas, although I don't expect specific ideas. Bryn, do you have any comment you want to type in on oil, and Mike and I will take a look at it and see if we see anything on our own particular biases or systems. Sunil, what are you looking at, if anything, specifically? And John, you too, please. We want to give some insight that you can either trade or fade. Anyone? Bueller.
Well, I just want to say, that we're gonna have Joe Vaclavic's ag overview. I'm interested to get some of his thoughts also on soybeans specifically, because that's really tied to trade. Had a strong open yesterday, but really faded. We're up 3 right now, but well off
Here we go.
yesterday's high.
Not to interrupt you,
Yeah, sure.
Bryn and Tracy are typing. Crude vol crush after next week. I posted charts over in commodity channel. Thank you, Tracy. Crude vol crush after next week. Okay. Crude vol crush after next week after the meeting. Generally speaking, Brandon, I think you know this, and I'm saying this for people I think who would benefit from your knowledge as well as mine. Generally speaking, just like in the old days when bond vol would be bid before a number, crude vol may or may not get bid or have an underlying bid to it going into a meeting. But assuming that it will, let's assume the market's not moving and factor all other things out. Crude vol will be bid going into a meeting. The question is, will it be bid uh, 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 on the call side or the put side? Generally speaking, before meetings, you see skew changes. And I'm not saying only skew changes, but you generally see skew changes, especially when OPEC cuts are on the table. You might see the put skew remain, but some people come in and start buying 5 and 10 delta calls. Why? Because they're stupid and they don't understand volatility comes when we go higher. But that's okay. What the smart thing to do is, and you'll probably see in options, you'll probably see some call spread buyers on the retail side or the CTA side. But to answer your question after the meeting, interestingly, generally speaking, okay, after the meeting, it's the market move that determines the vol. So if the market goes higher and vol, let's say if the market goes 1 standard deviation higher and vol is down 0.5%, I'll create that correlation. That's pretty much tied to the skew. After a meeting, if the market goes higher, vol will come in twice that amount after a meeting and the market goes higher. If the market drops, you have 2 factors here. The market vol will go higher because of the process on the put skew side, but it will be mitigated by people selling options. What options will they be selling? They won't be selling puts. They'll be selling calls. So you'll probably see some bulls pile in buying calls. This is me speculating. And if I see the flow, I'd be more particular about it. But going into a meeting, they buy calls. Okay. And then after the meeting, if we rally, vol gets annihilated. If after the meeting the market drops, vol gets annihilated at first because some puts are sold, and then the skew not reverses, exacerbates to the put side as people are selling calls as puts are being bought. So I think at the money, vol drops either way. If you want to sell vol, if you're a vol seller, you would sell a 40 or 30 delta call. If you're worried about being hedged, or if you're worried about being naked, you sell a 30 delta, 10 delta call spread. If you think vol's coming down, and that works if you're bearish or bullish to an extent. If you're bearish and you think vol's coming in, or put it this way, if you're bearish and you think there'll be an opportunity to buy vol before it screams out, you buy the 1 and then you sell 1.5, not a 1 by 2. You do a 1 by 1.5 spread, say 30 delta to 15 delta. I pick deltas because if you use deltas, you don't have to use time frames. Oh, I'm going to go 30 days out. Well, you pick the time frame. I don't care about the time frame. Deltas change over time frames. So to answer your question, Bryn, and I would appreciate any comment, agreeing or disagreeing. Vol after the OPEC meeting coming in, yeah, I think that's a given. The question is, how in the money will options be, the ones that you sold? Does that make sense?
Yeah, and I also like the way that you said annihilated, kind of like Larry. I'll replay that one for him later. He'll be proud. I
Annihilated? Oh, that's bad. That's bad. I'm
No, but
turning
you
into
gave
Larry.
yeah, a Larry voice on that one. I see. I just posted something. I saw an interesting something come across on the newswire. Burger King is offering 1 cent Whoppers if you happen to be near a McDonald's and you place a mobile order on your Burger King app. I guess the Whopper is 1 cent. So if anybody wants that for lunch, you should definitely
Okay,
check that out.
guys, I'm going to give you the arbitrage there. You buy the 1 cent Whoppers, okay? You take your 10-year-old child and you put him in a little lemonade stand in front of Burger King, in front of McDonald's. You buy the 1 cent Whoppers, you give them to your child at the burgers, at the little stand that you set up in front of McDonald's and you have him sell the Whoppers for 50 cents. Boom. That's how you make money. That's how it's done. It's arbitrage, folks.
Yep. Did one off for 50.
Of course, you get put in jail for using a minor to make money, but
All
that's
right.
how.
Well, that's good info. We'll be back to you, after the open with some updates. Larry will have some levels in a bit, but we'll be back to you there. And then also, so we're going to have Joe Backlevac coming up now. 11 o'clock, we have the options with Vince Lancy and Tom McEntee. 12 o'clock, Adam Collins of Movement Capital. And 1 o'clock, Larry Schnermacher of Phyto Partners on Cannabis. Talk to you guys a little later on.